The past couple months have been all over the place in the stock market. I remember September was bloody hell, but I was still able to make a little bit of profit on options trading last month. And then this month, we're basically seeing the opposite to what we saw last month with volatility towards the upside. So today, I'm going to teach you how to make money based on this volatility. Welcome back to Everything Options. My name is Greg, and today I'm going to be showing you the best option strategy for high volatility. So to break this video down for you, first I'm going to give you the strategy itself and the basics behind it. Then we're going to go over the risk because, of course, with anything you can always lose money. And finally, at the end of this video, I'm going to give you an actual example that you'll want to stick around for. But before we get into it, if you enjoyed this video and you learned something out of it, make sure to leave a like down below and comment what you want to see next. So the strategy itself, I'm going to be using in the money credit spreads. And the reason that I'm going in the money instead of, your regular out of the money credit spread, which would give you a better chance of making a profit, in the money credit spreads will actually give you more premium and you'll actually take on less risk inherently. And I'll talk about that later. But within in the money credit spread, you can actually open more of these spreads compared to an out of the money credit spread and take on the same amount of risk, which means that if you have 10 of these spreads instead of like 2 of them, for each dollar that the spreads move down, you're going to be making $10 instead of making $2. So in that way, I actually see in the money credit spreads as advantageous whenever you have high volatility like we're experiencing right now. And the way that I go about choosing my strike price is by actually looking at the amount of credit that I'm going to receive for opening the trade. So with every credit spread, you have a certain amount of collateral that you're going to put down, which is going to be the difference between your two strike prices times 100. So if I have a $1 spread, say a $100 and a $99 credit spread, in this case, I'm only putting down $100 since the difference between the two strike prices is $1. You multiply that by 100 for the 100 shares that you're controlling. And then, of course, for a $5 spread, you're taking on $500 of collateral. But for each of these spreads that you open, you're going to get a certain amount of credit. And this is how I go about choosing my strike price, by selecting the amount of credit that I want to receive. So I'm going to start by going in the money spread first. So with a put option, the strike prices are going to be below the current share price. And with call options, the strike prices are going to be above the current share price. And I'm usually aiming for, about 60 to about 70% of credit to the amount of collateral that I have to put down. So if I'm going with a $1 credit spread with $100 of collateral, I'm going to be aiming for about 60 to about $70 of credit for each of these credit spreads. And then whenever it comes to a $5 credit spread, I'm looking for anything between about $300 to about $400 of credit for each of these spreads. And with $500 of collateral for a $5 spread, this means I'm only taking on between about $100 to $200 of risk per each of these spreads, because the most I can lose is the amount of collateral in my trade minus the credit that I receive. So because of this, you can actually inherently open more of these trades and take on the same amount of risk as you would with an out of the money spread. And if you're aiming for maybe 20 to about 30% with an out of the money credit spread, this means you can open about 2, maybe even 3 times as many spreads as you could with an out of the money credit spread. So this is why I've been using in the money credit spread lately, and I've had pretty good success over the past couple of months. It's worked out really well for me. But of course, nothing is foolproof and we have to go over the risks, so let's do that. So the first risk that's associated with pretty much any type of spread, whether it be credit spread, in the money or out of the money, or debit spread, or really any other type of spread, is early assignment risk. Because you're selling an option, you run into the risk of early assignment, to where the buyer of that option can exercise their option early if it becomes in the money. And since we're starting with an in the money spread, this does increase the odds of this actually happening for us. But not to worry, it is going to be pretty rare, because it's either going to be a new trader that doesn't really understand what they're doing yet, or maybe run into like a dividend situation or something like that. But it is important to kind of keep in the back of your head that you might get assigned early on your credit spreads. And this means if you get assigned on the option that you sold, if it's a call option, you're going to have to sell 100 shares of the stock at your strike price. And if you get assigned on a put that you sold, you're going to have to buy 100 shares of your stock at your strike price. And if you don't have either the shares or the money in order to buy the 100 shares, you can just pull out the reverse Uno card, exercise the option that you bought in your spread, and this will mitigate the risk entirely. And you don't have to worry about it because your brokerage is going to take care of the trade for you to where you don't have to put up the money to buy and sell the 100 shares. This is why it's important to have a margin account whenever you're trading options, and I think it's actually a requirement for you to have a margin account and level 3 options trading in order to trade spreads. I'll make an entirely different video on that. If that's what you want to see, make sure to leave a like down below. But anyway, so that is the first risk associated with in the money credit spreads. Yes, you do run a little more risk than you would with an out of the money spread, but it's still pretty negligible, I would say. And the second risk that you run whenever you're running in the money credit spreads is the risk of having to exercise at the expiration. And this is why you should never hold options into the expiration date anyway, but if you do, here's what's going to happen. So if the stock is trading between your two strike prices on your expiration date, say we have a $100 and a $99 strike price, and we did a call credit spread, we would have sold the $99 call, we would have bought the $100 call, and with the $100 call option, we're agreeing to buy 100 shares of the stock at $100. But if the stock is between $99 and $100, our two strike prices on the expiration date, this means that we would have to agree to buy 100 shares at $100, but since the $99 strike price is still out of the money, we wouldn't get a sign on that. So we wouldn't be covered on this end of the trade to sell the 100 shares at the $99 strike price. So you see the issue here. If you don't have the money in order to buy the 100 shares at $100, then your account is going to be in a deficit, a $10,000 deficit if you have no cash in order to buy these shares. So always close your spreads before they expire. And finally, the last risk whenever it comes to in the money spreads is pretty obvious. Since you're starting in the money, you're already putting yourself at a disadvantage. And if you just continue to hold it to the expiration date, just hoping that the stock is someday going to turn around, you might just lose all of the money that you put down in your trade. So with our examples from earlier, we had a $500 spread. We were aiming for, about $300, $400 of credit per each of these spreads. This means we can lose about $100 to $200 per each of the spreads that we open. So don't go balls to the wall opening 10 of these spreads if you can't afford to lose $1,000 or $2,000. Only put down what you're willing to risk whenever it comes to options trading. It doesn't matter what kind of trade it is. It doesn't matter even if it's one of the safest strategies out there. Just don't put more money than you're willing to lose on any type of option. That's just my general philosophy. You don't have to follow it, but I'm a really risk-averse person. Maybe that's just me. And with that said, let's get into the actual example. So the stock that I'm going to be using this week is going to be Tesla, and it's nothing really for them or against them. They just had the earnings report. They've been a little bit more volatile recently, and since they've gone up so much over the past few weeks, I would be willing to bet against them. Not in the long term, because I think long term Tesla is going to be one of the biggest companies by market cap, if not the biggest company. This is my #1 position in my long-term portfolio, but I do realize the short-term potential of Tesla actually dropping from where it's at right now. So we're going to set our expiration date to 30 to 45 days out. So December 17th is what I would prefer right now. And I'm going to say that Tesla will probably be below $870 sometime between now and December 17th. So in order to make this trade happen, what we're going to do is sell the $870 call. We're going to buy the $880 call above that. And for this trade, we're only putting up $400 of our own money. That is our max loss scenario if we're wrong and if Tesla is above $880 by our expiration date on 12/17. But our max profit in this case would be almost as much as $600, which is the total credit that we're receiving up front in order to open this trade. This means that we're taking on a 1 to a 1.5 risk to reward ratio, which is extremely good. And there's a good chance, since Tesla has gone up so much over the past few weeks, that it is bound to see a pullback over the next couple of weeks. Now, I might be completely wrong. It could continue to soar up over the next couple of days, but I would bet on it coming down from this point considering just how much it's gone up over the past month. So I would be willing to make this trade, and for it, I would get $600 of credit. And if Tesla were to come down over the next couple of weeks, like I'm assuming, I could probably make between about $50 to $100 of our credit, or $600 of credit, and I could get out of the trade just then and there pretty easily. Of course, though, I could be completely wrong, and Tesla could just continue to soar up from where it's at right now. So do with this trade what you will. You can use it on any stock, whatever direction you want to bet. In-the-money credit spreads are great for this time right now that we're experiencing with higher volatility than usual. So use this to your advantage, use this strategy, and you should come away with pretty good profits if you're right on your assumptions. And that pretty much wraps up the video. So thank you for making it all the way to the end, and thank you to all my patrons for the support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.